Okay, let's unpack this. Today, we're diving into the latest from Analog Devices, ADI, big semiconductor player. We've got their fiscal Q3 25 report, plus the earnings call chatter. Our mission, break down the key numbers, see how they're doing market by market, and figure out what's next. So kicking off with the Q3 numbers, pretty impressive stuff. Revenue hit $2.88 billion.
Yeah, that's well above what people were expecting. Beat the high end of their own guidance, actually.
And it's a big jump, too, 25% year-over-year growth and 9% up from just last quarter.
Right. And what makes those numbers really pop, is the backdrop. The CEO, Vincent Roche, he mentioned geopolitical challenges, tariffs, trade fluctuations. I mean, it's not exactly smooth sailing out there.
So they're navigating some choppy waters.
Exactly. They exceeded expectations despite all that uncertainty. It really speaks to what they kept calling their diverse and resilient business model.
And it wasn't just revenue. Adjusted EPS, earnings per share, came in at $2.05.
Which was well above the $1.93 consensus estimate. That's a 30% jump year over year. Solid.
Plus, those margins looked good. Adjusted gross margin at 69.2%, adjusted operating margin 42.2%. Both improved nicely year over year.
Yeah, those margin figures show the underlying strength. It shows, I think, how their strategy is paying off, even when the broader economy feels a bit shaky. It's a good case study in resilience, really.
Okay, so strong headline numbers. But, the real story often emerges when we dig into the different markets ADI serves. They actually saw double-digit year-over-year growth across all of them in Q3. Let's break those down.
Absolutely. Each segment paints a slightly different picture, gives us that granular view.
Let's start with the biggest piece, industrial. That's like 45% of their total revenue.
Huge segment for them.
And it was up 23% year-over-year, 12% sequentially. Yeah. Really strong.
Yeah, the CFO, Richard Puccio, he called it a cyclical upturn. And it wasn't just one thing. It was broad instrumentation, automation, aerospace, defense, healthcare, energy, pretty much everywhere.
Right.
But here's a really interesting point they made. End demand is still double digits below consumption.
Okay, what does that mean exactly? End demand below consumption.
Well, it suggests there's still quite a bit of room for recovery, like the actual end users need more product than what's currently flowing through the sales channel. So they see this potential channel catch-up happening, possibly in Q4, more upside there.
Got it.
And, here's a surprising bit from their aerospace and defense business. Had a record quarter.
A record? Wow.
Yeah, they actually said their supply limited there because demand is just surging. Good problem to have, I suppose.
Okay, so industrial is booming. Let's switch gears to automotive. That's about 30% of revenue. It grew 22% year over year, which sounds great, but it actually dipped 1% sequentially. What's happening there?
Ah, right. This is the pull-in story. Q3 got a boost because customers, mainly in China, accelerated their orders. They basically pulled orders scheduled for later into Q3.
So they borrowed demand from the future, in a sense.
Exactly. And management expects that to unwind in Q4, so that bump they got in Q3 won't repeat.
Which explains why they're forecasting automotive revenue to actually decline sequentially in Q4.
Precisely. They're taking a, let's say, conservative view for automotive in the short term. They pointed to things like expiring EV credits in some places, ongoing tariff risks, stuff that could make car manufacturers tap the brakes a bit on production.
Okay. So that's a good example of those external factors messing with the quarter-to-quarter picture, even if the long-term trend is up.
Yeah, it shows how complex forecasting can be in this space,
Right. Useful context on those pull-ins.
Yeah.
Okay, next up, communications. 13% of revenue here, but look at this growth, 40% year over year, 18% sequentially. That's huge.
Yeah, that's largely the AI effect. They said continued AI infrastructure demand was the main driver, particularly in wireline and data centers, which are like 2/3 of that comms segment. So a direct line from the AI boom to ADI's results there.
Makes sense. And the last segment, consumer, also 13% of revenue, posted 21% year-over-year growth, 16% sequential.
Yeah, consumer's been really consistent. This is actually the fourth quarter in a row they've had double-digit year-over-year growth there. And it's pretty broad, too. Handsets, gaming, hearables, fancy earbuds, wearables. It shows their diverse product mix is working well in that faster-moving market.
Okay, so putting it all together, what's the outlook? What do they guide for Q4 and beyond?
For Q4, revenue expected around $3.0 billion, give or take $100 million.
Right. And they see operating margin ticking up slightly to 43.5%. Adjusted EPS guided to $2.22, plus or minus 10 cents.
So overall, positive trends continuing into Q4.
Generally, yes. They expect industrial, communications, and consumer all to grow sequentially again, industrial leading the pack. But, as we just talked about, automotive is the one they expect to dip sequentially because those Q3 pull-ins are unwinding.
Gotcha. Now let's circle back to gross margin. It was 69.2% in Q3. You mentioned they were hoping for closer to 70%. What happened there? Yeah, they flagged a one-time unexpected lower utilization event. Basically, a temporary dip in production efficiency at one of their European factories. Just a hiccup, it seems.
Ah, okay. So not a structural issue.
No, they were clear that utilization is back on track, and they're confident they'll hit that 70% gross margin target in Q4. A big driver for that will be the improving mix, with industrial expected to reach 49% of total revenues, and industrial is generally their highest margin business.
Right, that mix shift is key.
Yeah.
Okay, moving beyond the next quarter. This company generates a ton of cash, right? Free cash flow over the last year was $3.7 billion.
Yeah, 35% of revenue as free cash flow. That's a very strong number.
And they're returning a lot of that to shareholders.
Oh, yeah. In Q3 alone, they returned $1.6 billion, about $500 million in dividends, $1.1 billion in share buybacks. Over the last year, it's $3.5 billion returned. Their long-term plan is actually to return 100% of free cash flow, split between dividends, maybe 40–60%, and the rest buying back stock. Very shareholder-focused.
Now, thinking strategically, CEO Roche kept talking about innovation at the intelligent physical edge. What did that actually mean for their growth plans?
Well, what's really fascinating is how they're applying that to robotics and automation. That seems to be a huge long-term bet for them. They're projecting they can double their automation revenue by 2030.
Double it. Wow.
Get this, they think humanoid robots, when they become more common, could have several thousands of dollars worth of ADI components inside each one.
Thousands per robot. Compared to what now?
That's like a 10x increase compared to the content in current autonomous mobile robots. It's because these new robots will just have an explosion in sensor and actuator counts, as they put it.
Way more complex.
10 times the content. That really does sound like an exponential opportunity if that market takes off. It really does. And they're not just waiting for it to happen. They're partnering with NVIDIA on things like digital twin simulation programs, basically virtual robot models and reference designs. The idea is to help their customers develop these advanced robotic systems faster using ADI's tech. Smart move to collaborate like that.
Makes sense. And operationally, how are they managing inventory and manufacturing, especially with all the market ups and downs?
They're trying to strike a balance. Keep inventory low out in the sales channel so they don't get caught with too much stock if demand shifts. But at the same time, they're holding higher levels on their balance sheet, meaning more inventory internally, so they're ready to support the recovery when it really kicks in.
Preparing for the upswing.
Exactly. And they're investing in CapEx too, about 4–6% of revenue this fiscal year, to boost their manufacturing resiliency, especially for their own internal factories that make a lot of the industrial products. It's about securing their own supply chain.
Okay, and just a quick point for listeners. You often hear companies like ADI talk about adjusted or non-GAAP numbers. Maybe just quickly explain why they do that.
Sure, that's a good question. Management uses these non-GAAP figures internally to kind of gauge how the core business is doing day to day. They basically exclude certain items, things like costs related to buying other companies or unusual one-off charges that they feel don't reflect the ongoing operational performance.
So it's meant to give a clearer view of the underlying business trends, separate from those specific, often temporary items.
Precisely. It's not about hiding anything. It's just providing another lens. It helps you, the listener, understand the different ways companies talk about their financial health. It's good to look at both GAAP and non-GAAP to get the full picture.
Great clarification. Okay, so let's quickly wrap this up. Analog devices, strong Q3, beat expectations. Looks like a solid cyclical recovery in their key industrial market. They're navigating some challenges, sure, like those automotive pull-ins and the wider geopolitical stuff, but the focus on the intelligent edge, especially robotics, that seems like a really compelling long-term story.
Absolutely. If you connect it to the bigger picture, what really stands out is how ADI is playing to its strengths, that deep engineering know-how, the broad product portfolio. They're using those not just to manage the current market swings, but really to position themselves for these huge future tech waves like advanced robotics. I mean, that idea of thousands of dollars of their content per robot, that really highlights the potential scale we're talking about.
Yeah, that's a powerful thought, isn't it? Thousands per robot. So as you go about your day, maybe think about this. Where else, maybe outside semiconductors, are companies doubling down on what they do best, finding ways to innovate for those, exponential growth opportunities, even when things feel turbulent globally? something to chew on until our next deep dive.